It is August 13th and it's 10 o'clock on the West Coast, and we are ready to get started. We've got a presentation today on self-directed retirement accounts, different types of accounts actually, and what you can do with them, why to look at one account versus another, and what they're going to open up for you opportunity-wise. And I guess I'd like to start off saying, my name's David Moore, of course, but none of this is actually new. I mean, since retirement accounts were started in the mid-70s, everything we're talking about today has been possible. It's just a very, very well-kept secret. And I was actually on a call yesterday with some people that were looking to actually sell a business, and the buyer was in a situation where they were looking to get a bunch of funds together from a variety of sources. Some of those sources were pretty expensive sources, and somebody had brought up the possibility of using qualified money, IRA 401k funds, to make that investment. And they had thought, hey, that's a good idea, and they went and talked to their tax people about it, and the tax people said, you can't do that. So we're going to dispel some of these awful rumors today, and we're going to give you an idea of what's possible. We've got an hour, so we're not going to get into the down and dirty stuff on these things. If you've got questions, I would invite you to reach out afterwards, and we'll address those questions offline. If you are in the real estate community and you are looking for CE and it's in a region we can provide CE for you, please do not hesitate to reach out to CMoore, C-M-O-O-R-E, at 1031exchange.com, CMoore at 1031exchange.com. And you might be thinking, hey, I'm on this call for retirement accounts. What's 1031exchange.com? That's a sister company to IRA Advantage that handles tax-deferred exchanges. So I got a lot of info to get through, not a lot of time, and I have a tendency to run long, so I will do my best to stay on track and get you some good information. We want to provide nuggets of knowledge. Like I said, you're not going to understand everything about this process, but I hope you get through this with a lot more understanding of what is possible. So, back to my situation yesterday with that store and the tax people and the just sort of misinformation that was put out there. And in that conversation with those people, it's a question of, what type of account is really going to be driven by what that person's intentions are, what their needs are, what they're going to be doing with that investment. Is it an investment or is it a job creation? What are we actually doing? So when we engage somebody in this space, a conversation, I really encourage people to give us a call, because we can get through a lot more information with a conversation than going back and forth via email. It just takes forever, and it's a cumbersome vehicle. So give us a call. We can get through it quickly and sort of say, hey, this is what you have, this is what you want to do with it, and this is how we're going to help you get there. And there's lots of opportunities out there that people just are not aware of, and it's our job to open those things up. If we're talking about in the taxed world, we're going to be doing that via 1031 exchanges and equity advantage. If we're looking at the qualified world, we're going to be doing it via IRA advantage and self-directed retirement accounts. So we do not sell investments. We do not get anything if you buy investments. We do not provide investment advice. We are going to listen to what you have and what you want to do with it, and we're going to provide the investment vehicle necessary to get you there. So the only dumb questions one you don't ask, and I look forward to having conversations with you on your future, really. So we like to say it's your money. What do you want to do with it? And I think this is something that's lost. And really, if you're paying attention just the last few weeks, obviously, like I said, we are in August of 2025. We've had the Trump administration in office now for a few months, and we've got that quote unquote one big beautiful bill that was passed, and we continue to have some more things coming out that are very interesting actually to the investment world. I think one of them is, you think about talk that has come up recently about the universal exclusion on a home sale, Section 121. That was put in place in 1997. It offers an individual $250,000 exclusion on the sale of a primary residence, $500,000 for a married couple. You can do that once every 2 years. Well, those numbers were 1997 numbers. They don't really do much for you today. And I kept waiting and waiting and waiting for somebody to address this, and I hadn't heard anything. And then finally, Tina in my office came to me, I don't know, probably a month ago and said, hey, so-and-so's brought this up. And I go, really? I haven't heard anything about it. So we're hearing more about it, and potentially the elimination of all tax on the sale of a primary residence. Obviously, if that were to happen, there's going to be a whole bunch of rules that come into play. We're going to be looking at that stuff. But that's one of those situations in the tax world where it's a moving target. Things continue to evolve. We've got the discussion on interest rates, and it sounds, once again, we are expecting some type of drop probably mid-September. That's one of the reasons, if you're in the real estate world, the market's been a little bit slow. I think people are waiting for that to happen. I think people got used to free money. I think they need to get used to something for that money. The cost of capital is there. And when the federal government really has no money, why should Fed funds be virtually nothing? So, I mean, it's one of those things that's out there. There's lots of pressure to drop rates to hopefully stimulate some market velocity. But in the meantime, I think IRA and 401k funds have been a source of capital for a lot of different people that we've worked with over the last few years. Everything from builder developers creating investment funds for friends and family to invest in that would allow them to buy property or use that money for construction without dealing with the red tape from the banks. We've got people that come to us that want to take their retirement accounts and go create a new business to literally work for. We've got people that come to us that want to buy. I'm just looking at, I've got a screen going in the background right now, and they say, well, crypto's at all-time record highs today. We have people that come to us, they want to buy crypto. Precious metals, a lot of people, obviously, people that want to buy notes or make loans. But we like to say, invest in what you know, and we're going to sort of help you get there. And in Wall Street world, if you've got specific knowledge of something, you've got insider trading rules that prohibit you from taking advantage of that. In the self-directed world, if you're, let's say, a mortgage broker and you want to use your retirement account to go make loans, you can do that. If you're a real estate broker, hopefully you've got specific knowledge of opportunity there, and it's going to reduce your risk and help you get to where you want to go, want to be actually in the retirement period. So why not decrease risk and take advantage of your expertise and get you where you want to be, whether we're creating investment opportunities or maybe even business situations. But this is not something, like I said earlier, that's new, and it's a situation where we have the ability, it's not all or nothing. If you've got an IRA, we're probably going to encourage you to keep your Wall Street money right where it is, and only move the money you want to use in the self-directed capacity. If we're creating a 401k plan for you, we're going to encourage you to consolidate retirement accounts. Why maintain a whole bunch more than you need? And we'll talk about why I've got that different position with IRAs versus 401k plans in a few minutes. If we're looking at a situation where we are creating an opportunity to go out and actively invest time-sensitive investments, we're going to create one type of account. If you've got a single non-time sensitive situation, we might create a basic self-directed IRA. If you've got a business situation where you want to buy or create a new business you're going to work for, that's going to require something else. So we're going to talk about all these different investment vehicles, what they're good for, how to create them, and why to use them. So I hope you find the information helpful. Self-directed accounts, okay? Self-directed is not a legally defined term. It's just a term that describes an account that allows you to go buy what you want to buy. And as I said, this is not new. It's always been possible. And it's sort of been interesting. Now we've been in this space for almost 20 years at this point, but it's one of those things where people continually say, well, I didn't know you could do that, or how come I was told I couldn't do that? And really it's just information that's just not readily available. If you talk to most financial people, Wall Street people, they understand what you can buy. I mean, as far as what they can sell you, as far as what an IRA or a 401k plan can actually buy or invest in, what they can do. Typically, that's not something they're trained in. It's not their fault. It's just that they're going to be looking at your situation and providing Wall Street solutions to your investment needs or retirement needs. And we're going to look at it totally different. We're going to say, okay, hey, you've got X dollars in your retirement account. What do you want to do with that? What's going to help you get where you want to go safest and most comfortably for you? And diversification is always going to be the answer when we're looking at this stuff. You don't want to have all your gold in that one bucket and that bucket goes south. I don't care what the investment is. You should have some diversification there. So we're looking at the Wall Street stuff. Why not have it diversified, just like the money out of your pocket? You've probably got financial accounts in Wall Street firms for money out of your pocket, as well as your retirement account. You've got probably the real estate you own is solely owned by money out of your pocket. And we're going to talk about how that compares to money out of your pocket into a given investment versus qualified money. And rarely in life is it just an absolute, you got to do something one way. Typically, there's always an up and down to each of those things. We'll talk about those situations and what might work best for you. So what I want to say on this slide actually is any IRA can be self-directed. If we're looking at moving IRA money into 401k plans, we've got some restrictions there. Any IRA can be self-directed. When we're looking at 401k plans, we've got to look at if it's a current employer plan, previous employer plan, your age, and that's going to dictate whether we can use those funds or not. We've had people literally quit their jobs to get access to money. So, and I would, I hear ads every so often, and you've got to be clear on what a self-directed account, truly self-directed account is. Most financial firms will offer what they say self-directed account is, in their definition, and that's going to be something that allows you to buy what they want to sell you from their investment menu. And that menu might be broadening because President Trump just recently is introduced legislation that would open up a whole bunch of additional investment opportunities for people in just, let's say, Wall Street focused or centric plans. Our plans, if it's a 401k plan, is going to allow you to buy anything the law allows. If you come to us and say, I want a self-directed IRA, it's going to be an account that allows you to buy literally anything the law allows, not some off some list of menu options there. So when we look at this stuff and what is possible, really, we could sit here all day long talking about what you can invest in. It's much easier if we look at it from the context of what you can't invest in. And if we look at that sort of menu, the way the law works, unless it's specifically prohibited, it's therefore allowed. So we'll talk about what is specifically prohibited. So why do people come to us and want these accounts? Well, I'm looking at a screen right now. It says the market's up 300 points. Yesterday it was up, I think, 400 and something points. Last week it was down. I mean, so up, down, day to day. The great thing about Wall Street is you got liquidity, right? If you don't want something, you sell it. And if you want it, you go buy it. The tough thing about real estate can be that it's considered illiquid. So for you to sell it, you got to find a buyer for that thing, and it changes things. So the liquidity of Wall Street gives you that roller coaster ride. The illiquidity of most hard assets, tangible assets, especially real estate, is you don't have that immediacy. So therefore, the whoop-de-doos, the ups and downs are much less obvious, let's say, and take more time. So, people come to us because they are tired of watching the market go up and down. They want to buy something that's going to be more stable, greater financial control. David, what do you mean by that? Well, if you've got a traditional Wall Street account, the money's with that firm, and you're going to be buying, selling through them, and it's only as that can happen. Well, if you've got a self-directed account, you're literally, the investment source of investment, if you've got a checkbook IRA or solo 401k, is the money's literally where you've put it. So instead of having the money across country in some investment firm you don't really know, if you've got a bank locally you like, that's where your money is. So, people come to us because they just like the fact that their checkbook IRA or solo 401k, that account is right where they want it. Investment, we talked about that. And as far as your ability to do it, You know, I always jokingly say I'm not Martha Stewart's best friend, but you cannot, or biggest fan, but you cannot tell me she's the biggest culprit on insider trading. You know, why did she get, you know, why did she get the problem when so many people that clearly are taking advantage of the system are not in that same boat? So in the self-directed world, you can invest in what you know. Wall Street, typically, you're not supposed to be doing that. Increased investment flexibility. Why not have an account that allows you to buy anything the law allows, instead of something that's just going to pigeonhole you into one set of potential investment options? As I said earlier, with IRA, we're probably going to segregate different accounts, and we'll talk about why in a few minutes. The 401k plan, we're just going to shove everything in aggregate accounts as we can. All right. Real investments, not alternative investments. This is one of my biggest pet peeves, okay? Name an older investment than real estate or precious metals. They're the oldest investments known to mankind, and yet in the investment world, those things are considered alternative investments, and actually the association that governs these things actually has that integrated in the name. I mean, it's sort of crazy to me. So I don't like to say they're alternative investments. I like to say they're real investments. If you want to buy notes and loans, you can do that. Community-based investing, you want to make a difference in your community, you can definitely do that. Take advantage of today's opportunities. You've got literal immediacy of investment. If you've got a 401k plan or you've got a checkbook IRA, you literally can make that investment by writing a check or wiring funds into something, but you've got immediacy of investment in anything the law allows, which is a wonderful, wonderful thing. Tangible assets are great hedges against inflation. Anybody up watching TV late at night is going to see advertisements for gold. They're going to talk about something called a gold IRA. There's really no such thing as a gold IRA. It's just an account that allows you to buy gold. Why have that? I mean, we've got precious metal dealers that send us clients all the time for checkbook IRAs. Why would they do that? Because it allows that immediacy of investment, allows making those investments into the things they're selling to be done very easily. And then as far as storage of that gold, it doesn't have to be in some depository someplace that you don't know. You're going to have, if you buy gold with a checkbook IRA, for example, you're typically going to be making the investment in the LLC's name and EIN. You're the manager of that limited liability company. The member is a trust company for benefit of your IRA. You're going to open, you'll have a bank account in the LLC's name and EIN, your signer as manager. And if you've got the gold, you're going to have a safety deposit box in the LLC's name and EIN, and that's where the gold's going to be. You're not going to put the gold in your house. That's not going to be okay. But as far as putting it in that safety deposit box, having it there in the LLC's name and EIN, with the member being your IRA, that's all going to be fine. And tangible assets are great hedges against inflation, and people that are concerned about just the world in general have a tendency to sort of fly to hard assets, precious metals. Security, what do I mean by that? Literally, you're putting the money where you want with people that you know instead of someplace across the country. If you want to buy crypto, as I said earlier, we're sitting at record highs right now. If you wanted to do that, it's sort of interesting to me because over probably the last decade, we've had ads on these things that we ran on the radio. One year it would be boom, and the next year crickets, and it's really just dependent upon what's going on in that market. If you want to do that, our accounts are going to allow you to do that. And then finally, we've got the opportunity to go out and buy a new business if you want, literally one to work in and be compensated by. So it could be the olive branch to that new business that you never thought was possible. What investment vehicle do I need? Now, remember back a while back, I said we don't sell investments, nor do we provide investment advice. What we're going to provide is the investment vehicle necessary. So when somebody comes to us, we've got a series of questions that we want to know. What's the source of money? What, how much is there? What do you want to do with that money? And then we get the answer to what you want to do with the money, then we're going to know what sort of direction we are going to need to take. And a basic self-directed IRA, just for the sake of the slide, it just means we're going to create a custodial account And any restriction in investment you've got today is based upon the custodian or the company, the investment company you're working with. It's not in law. All right. So when we look at a self-directed account, it's going to allow any investment the law allows. If you said, gee, David, I want to invest in, I've got some, somebody that has put a investment fund together to go buy this parcel of property, and I want to invest in that. Well, that's a single, non-time sensitive, passive investment in my sort of thinking. All right. So what we would do in that situation is the least expensive, probably more cumbersome situation, but it doesn't really matter. We're just going to do a basic self-directed IRA. We're going to move the money you want to use in this capacity from a trust company that won't allow you to do what you want to one that does. And then you would submit the investment to the trust company. They're not going to make an investment based, or make an investment or not make an investment based upon their deeming it's a great investment. They're just going to do it based upon their judgment as whether it's a qualifying or non-qualifying investment. So if they say, hey, this is something that's a qualifying investment for an IRA, they're going to make the investment when they've got the appropriate paperwork. So a basic self-directed IRA is going to allow that thing to happen, and it's going to be very low cost, and it'll get you where you want to go. Now, if you said, David, I want to go out and buy real estate and I want to manage it, well, that's not going to work with a basic self-directed IRA. You're going to need what's called a checkbook IRA. And just for the sake of the conversation right now, all that means is we're going to still create the custodial account. As a custodial account's being created, we are also going to be creating an IRA-specific limited liability company. So a moment ago, I mentioned the structure of this. So the member of that limited liability company would be the trust company for benefit of your IRA. You would be the manager of the limited liability company. So it's a manager-managed limited liability company. The member is the trust company for benefit of your IRA. You are the manager. So as the money's moving from trust company A to trust company B, we would have created the LLC, gotten you the LLC, the federal tax ID number for it. You go to a bank, open a checking account, and instead of the trust company making the investment in that ultimate investment, the trust company is going to make an investment in the LLC that you're the manager of. That funds the bank account, and now for you to make that purchase of that property, you're just going to negotiate from deal inception in the LLC's name and EIN. The offers between the seller and your LLC. You need earnest money, you write a check, you go to close it, you write a check. During the time of ownership, any income goes into that account, any expenses paid out, the property goes full cycle, the funds go right back in the account. So as the money's piled up in that account during that time of ownership, you have the ability to put it into savings accounts, or put it back into Wall Street if you want. That's a conversation we'd have on what is the best course to do that. But that checkbook IRA allows you immediacy of investment, and it allows you the ability to manage the asset. Now, you can't go out and work on it. That would constitute a prohibited transaction. But as far as administrators' functions of management, that's going to be fine. Now, if I find out that you want to make that same investment maybe, but you are self-employed without employees, I'm going to do a solo 401k. And that's for a variety of reasons, which we'll talk about in a few minutes. But really, if we look at a solo 401k account, what's going to happen is we want to move all the money, where the checkbook IRA, at that point, we're just going to move the money you want to use in the self-directed world, because we don't want to encumber your Wall Street investments with that money. If it's a 401k plan, the cost of a prohibited transaction is entirely different. So we're going to move all the money that we can into the 401k plan. Now, we can't migrate Roth IRA money, nor a beneficiary and inherited IRA. We cannot move those funds in a new 401k plan, but any other IRA should be able to be moved into that 401k plan. And obviously previous employer 401k plans, we can move that stuff. If it's current employer plan and you're old enough, we can move that money too. But the solo 401k gives you the flexibility of a checkbook IRA, but it's more forgiving. The contribution limits are slightly higher, and a 401k plan you can borrow from where you can't with an IRA. So there's a few different things we'll talk about further, but that's another investment option for you. And really, with the checkbook IRA, you're restricted to only a few different things. You can't buy stock in a sub S corporation, and you can't buy collectibles, and we've got very, very few restrictions there with respect to the IRAs. 401k plan, the only thing we can't buy is collectibles, so it's even more liberal with respect to what you can and can't do. Rollover Business Startup is sort of the last of the menu choices, and that's a situation where we've got a basic IRA that's just a custodial account. We've got a checkbook IRA, which is a combination of a new trust company with a new custodial account with a trust company, allows self-directed investments, and we're going to combine that with an IRA-specific limited liability company. Solo 401k is just a plan. If you're looking at a business startup, we're going to have a 401k plan and a C corporation. So once again, in the IRA world, we're probably looking at limited liability companies, and in the 401k world, if we're looking at business startups, it's going to be a combination of 401k plan and a C corporation, and we can't switch those things back and forth. There are situations we did a self-directed account checkbook IRA for somebody a year ago or so, and you've got to look at a situation, say, okay, am I making an investment, or actually am I sort of working in a business context? And the consequence of those two different things is different. If you purchase, let's say, an apartment building, and the apartment building has a laundromat in it, well, the apartment building, the cash flow off it, that's all investment yield. That laundromat would be a component of that. So we made an investment in that situation. If we then say, gee, we like that laundromat, so we're going to go out and buy just a laundromat, now your IRA owns a business and it's conducting business, and the government does not want that business to be competing unfairly with the taxed world. So in that situation, even though you say, well, gee, David, the apartment building had a laundromat in it, it was all investment. In that situation, now you're telling me the laundromat is a business. Well, it is. If you're flipping real estate, for example, too, that's not an investment, that's a business. And there's something called a Clarkowski court case, 9 points used to determine dealer status. We're talking about 1031. We're using that court case to decide whether you qualify for 1031. If we're looking at a business issue with respect to an IRA, then we're looking at those 9 points and sort of trying to ascertain whether or not you're conducting business. If so, you're going to be subject to something called unrelated business taxable income, UBTI. It's not a reason to make or not make a given investment. It's just another factor to compute into your ultimate return on investment. So once again, if you go out and you find this perfect business, we can use a Rollover Business Startup to get you there. So any IRA can be self-directed. So we're looking at things, and any IRA can be self-directed. If you want to combine, let's say, traditional IRA money, which is pre-tax money, growing tax deferred, you want to combine that money with Roth IRA, which is tax money that grows tax-free, we can do that, but it's going to require two different custodial accounts, and each of those custodial accounts would then be owners of that target investment. Now, if we're using an IRA LLC structure, we could maybe have those two entities as tenancy and common owners, or we can take direct ownership via limited liability company, multi-member limited liability company that has both your traditional and Roth IRAs as its members. We've got a slide a little bit later talking about checkbook IRAs. We'll talk about that a little bit more. But we can combine multiple IRAs into it. If we're looking at a variety of, let's say, pre-taxed retirement accounts, simple SEPs, traditionals, all those, we can typically maybe aggregate those all into one account instead of having a variety of accounts. You're paying fees for each account, right? So we're going to sort of look at and say, well, what is going to be most cost effective and least cumbersome going forward? But any IRA can be self-directed. If we're looking at 401k plans or funding one of these things, we have to look at what's happening. If you're under 59 and a half and it's a current employer plan, it's going to be off, sort of off radar for you, unable to be used. And as I said earlier, we have had people literally quit their jobs, get access to money. I've had business owners step away from their business for a period of time to get access to their 401k funds. So, depending on age, depending on what's going on with that, the 401k funds may or may not be available for self-direction. Is it difficult to create one of these things? And no, as we said earlier, a basic account is very easy to do. You don't need us for that. I mean, if you want to do a single non-time sensitive investment, a basic account's going to take care of you. And that is something, if you are interested, and you give us a call, and we're going to give you a couple of trust companies that we work with that we really like working with. And I guess I've got a couple comments on trust companies real quick. When you're looking at one, don't just pick the one that's the cheapest, all right? You want to make sure you're picking one. And with a basic account, you've got a lot of interaction with that trust company. Every time you buy or sell anything, you're working with them. Annually, you're going to be reporting valuations of what you've purchased to them. And then when you get to a point where you've got to take required minimum distributions, you're going to be calculating those things, working with them to take those distributions annually. So you want a trust company that's going to be there, that's going to be available and going to be able to answer questions for you. Something people do not think about is how that company charges you. All right. They think about what they're charging you, but they don't think about how they're charging you. And the other thing that we are really aware of is what that company's requirements are for a checkbook IRA. So anytime somebody comes to me and they want to pick ABC Trust Company, if it's not one that we typically work with, I want to know, one, how do they charge my client? I didn't say how much. I want to know how, because if we're looking at a Wall Street IRA, being charged on the value of the account, that's a simple thing to figure out. You've got a stock quote price every given second of every single day. So as far as valuations of what you got, that's not an issue. In the self-directed world, value is subjective. I mean, what's a piece of property worth? And you've got to understand there's a huge spread in those things, right? I mean, if we look at just court cases in the last couple of years that brought against, for example, a certain Palm Beach property was valued at 18 or 20 million when the last reports I heard was possibly 2 billion in value. So you start looking at things, and if you're an investor, you want it valued at 18 or 20 million, right? Because if you were to take the property as a distribution in kind, you'd have tax on 18 to 20 million, not 2 billion. So valuations are really subjective in the real estate world. I mean, what is something worth? And typically it's going to be worth what the buyer and seller agree to, but appraisers, I'm sure anyone on this call that's bought or sold property over time has had an issue with an appraisal coming in that didn't maybe do what you wanted to do. Well, when you start looking at ways to take property, let's say a lot of our clients will buy a piece of property and they ultimately want to take the property as a distribution. They want to personally own it or use it at some point. So what we're doing is looking at taking that property out in kind as a distribution, and typically you're going to do it over a series of years, which opens up some other opportunities, but you're always looking at a valuation opportunity there. So when you're sitting there selecting that trust company, you don't want to be paying that trust company based upon the value of your account, because now you're fighting with them every year on valuations. You probably want them to be valued low, and they're wanting them to be valued high. I mean, if we look at the last recession, I had a situation, I had a client who had $1 million note that had gone south, and he's sitting there fighting with the trust company about its value. He knew it wasn't worth anything, and they wanted to charge him based upon the $1 million valuation. Don't get yourself in that situation. So typically we work with trust companies that are going to charge you based upon the number of investments you've got, not the value of those investments. All right. Now you say, well, gee, David, that every time I've got 20 investments, I've got 20 fees. Yes, that can get expensive. That's where the Checkbook IRA comes in, because the Checkbook IRA, IRA LLC, if you're working with us, it's the Checkbook Advantage IRA. Well, in that situation, the trust company has one investment, the membership interest in the LLC. You, as the manager of the LLC, you could have 50 different investments in that LLC. The trust company's charging you for one. So that's why it's very important to understand not just what they're charging you, but how they're going to charge you. The other component picking these trust companies is, if you're interested in a Checkbook IRA, you got to know what their requirements are for that. There are trust companies that might not have any requirements. There are trust companies that will not allow you to be the manager of the LLC, which totally defeats the purpose of it. There are trust companies that will say, hey, your tax or legal people have to sign a document stating they're experts all things IRA. I tell you, they're not going to want to sign that. And there's trust companies that might say, well, hey, we require a third-party review of the LLC's activities annually. And so, understand, don't just pick one based upon the price. All right, you're sort of going to get what you pay for. Pick somebody that's got a great reputation. And once in a while, people say, well, gee, these self-direct custodians could be scary to me. I don't trust them. Well, think about this. With a Checkbook IRA, one of the reasons people like Checkbook IRAs or IRA LLCs is the only money you've got the trust company at the trust company is just enough to cover their annual fees, probably, because everything else has been invested in your IRA LLC, that LLC's bank account, which is literally at the bank that you've picked. So that's that greater financial control and safety and what you're wanting to see. You're literally putting money where you want it with a Checkbook IRA instead of having the money with a trust company that you may or may not know too. So really, it's just comfort for you, ease of investment, frequency of investment, what you do for a living, what you're wanting to do with the money. All those are factors that are going to come into the decision on what type of account that you ultimately want to use. Common objections. Now, this is the one that's sort of comical to me, because every time, and there's certain investment firms that I have literally the same objections every time. And these are four that we typically hear when somebody talks to their tax people or legal people or financial advisor about self-directed account. First one is, well, gee, why would you buy real estate with your retirement account when you're going to lose long-term capital gains tax rates? And that's true. And that is, if you're saying, hey, I can only make this investment with money out of my pocket or the qualified money, I'm better off to do with money out of my pocket. The answer is yes. I mean, because the great thing, like, for example, 1031 sort of considered the IRA for real estate. I mean, 1031 allows you to take your money, go buy a piece of property, and then when it goes full cycle, the exchange is structured and all gain is deferred. So it's like an IRA, for example. Every time you sell it, the gain gets deferred. The deal is that if you look at qualified money, IRA 401k funds, you're looking at tax deferred, growth throughout that life, unless it's Roth money, which is, tax money that grows tax free. But you've got, at the end of the day, you're going to pay normal income tax on anything that you pull out of that account, period. It doesn't matter what you buy. So although that statement, loss of long-term capital gains tax rates, does apply, it's really a pointless statement, because there's nothing you buy with a retirement account that's going to give you that. So really, the true question should simply be, what is the highest best use for the money in that account? And you should be using your money to make those investments. Second point, cannot be leveraged. Well, why would you take your IRA or 401k and go buy these things? Because you can't leverage an investment. Totally incorrect. You've just got to have non-recourse debt, and that just means that in a default, that property is all they can take. They can't go after they can't go after your retirement account. And I guess that sort of leads me to something that I really cannot stress enough. Do not look at your retirement account as you. I was talking to Buddy last night. We put an account together for a short while ago, and he kept saying, well, I'm doing this, I'm doing that. I'm going, no, you're not. It's not you, it's your retirement account. So think of it as Susie down the street. You're not going to co-sign a loan for her. You're not going to insure her property. You're not going to take her cash flow. That account is not you. That account is your retirement account. As long as you keep that in mind and think about it, and we bring it right back down to, if we do an IRA LLC, we might have somebody, your first, maybe objective for a name would be to put your name on it. Well, we don't want you to do that. Have fun with the name of the LLC. Make it a name that you, every time you look at it, you understand that is not you. And I just think it's one more layer of protection, because as I said earlier, if you've got a Wall Street IRA, you can make a poor investment, but you cannot really commit a prohibited transaction. In my world, you can make a poor investment, and you can also commit a prohibited transaction. So you have to be mature about this stuff. You have to be careful, conservative. And in my experiences, typically people are. I mean, I might handle exchanges for somebody for decades, never see them, and then all of a sudden we do a retirement account for that same party, and they're in my office. And well, gee, Peter, worked with you for decades, never saw you. Now I'm seeing you because of retirement account. Well, why? Well, this is my retirement. And it's like, well, what's the other money? But anyway, it's just people have a tendency to be a little more conservative when we're looking at IRAs, 401k plans, and I think that's well justified. So what about RMDs? RMDs, require minimum distributions. Now, when you get to a point where you've got to take those, you need to have enough money in the account to take that distribution. And one of the objections Wall Street has is, well, hey, you've got to take an RMD in that world. You just sell the shares necessary to yield the cash to take the distribution. What they don't contemplate is in-kind distributions. What's an in-kind distribution? In-kind distribution means instead of taking a cash distribution annually, you might take a piece of an investment or an entire investment. If you're taking a piece of property, you just took a distribution of all equity in that property. So if you take a minority interest in it, that is, once again, you got valuations there, but you may be in a situation, if it's minority interest, where you can actually discount that valuation even. That discounting applies to gifts, for example, in estate planning world all the time, because that person receiving a minority interest doesn't have control of the property. Therefore, what they've received is not worth the face value. That same strategy can be employed in an in-kind distribution. So when Wall Street says, hey, you can't, this is a problem. What if you have an RMD that's necessary, you don't have the money to do it, you just simply take an in-kind distribution. If it's a piece of property, if it's owned, you could take a TIC interest, tenancy in common interest, or you could take a membership interest in a limited liability company. A simple assignment can accomplish that. So not only is the RMD problem not a problem, I think it's a tremendous opportunity for people that want to take advantage of it through the discounting, so on and so forth. But it's just one of those objections that come up. And then finally, we've got people say, well, gee, if you buy real estate with an IRA, you're losing interest deductions, depreciation. Those things are true. And it's sort of interesting. I spoke at a broker-dealer conference a few months ago, Tom and I did, and we had in the breakout sessions after the main forum event, we had a broker start up that sort of path, and he raised his hand. Hey, during the main presentation, you talked about using qualified money to go make these investments, and what I lose these things. Why should I do it? So back to, I just simply asked a very basic question. I turned it and I said, well, true. I'm not going to get those things. I may take them if I've got an IRA and it's got debt on the property. I may employ those things, and that's a conversation to have with your tax people. If you got questions on that, give me a call. But typically you're saying, yeah, I'm not going to have those things. But I turned it back on them. I said, okay, you're correct. Can you give me an investment that is going to offer me those things? And once again, it was a blank face, because there's not an investment that person could sell me that's going to give me those things. So a lot of these objections are maybe valid, but they're pointless, because you've got to apply it to everything in your investment world, and you can't. It's just one of those things where when you start trying to poke holes in it, you're poking a hole in one aspect, but everything else on that menu of investments has that same trait. So you've got to look at it and say, okay, it's not these specific investments that allow me or disallow me from doing it. It's really the investment vehicle that's going to allow me to do it or not allow me to do it. And so this is why when we're looking at putting these things together, it takes typically, maybe for a 401k plan, maybe we can do that in a week. If we're doing a Rollover Business Startup, maybe it's a couple of weeks. If it's Checkbook IRA, it's probably going to be the better part of a month. And it's not because it takes a month to put it all together. It just takes a month to get everybody to move everything, because you've got to go to cash in the amount you want to fund these accounts with. So you got to clear that, get it set up, and then we've got to, depending on whether it's plans or let's say trust accounts, it takes time to get those accounts open, and then it takes time for the source of funds to react and send those funds where they need to go. So just be aware, if you're a broker working in this space, somebody says, hey, I want to take my retirement account and go do these things. Your first question is the account established? Your second question is going to be, what type of account is it? Because that's going to dictate how you write the offers. So it just, be prepared, like the old Boy Scout saying, be prepared, and take the time, get the things set up before you go to make these investments or start making offers, because that's where we can have potential for prohibited transactions. So is this complicated? No. I've got two issues I've got to look at in these things. What's a person want to invest in? And we sort of broached this earlier. I mean, the only things prohibited from an IRA are collectibles, life insurance contracts, or stock in a sub-S corporation. So rarely does anybody come to us and want to make one of those investments. 401k plans, sole restriction is collectibles. So rarely is the investment a problem. What triggers problems is transactions between or for the benefit of a disqualified party. So, once again, if we're looking at what you can buy, IRAs, anything other than collectibles, life insurance contracts, stock in a sub-S corp, 401k plans, sole restriction is collectibles. What causes the problems is disqualified parties. So there's no self-dealing or dealing with disqualified party in this space. Now you can't, so you couldn't buy from, sell to, loan to, borrow from. You can't buy a property for disqualified party to use. So your question, who or what's a disqualified party? You got lineal ascendants, descendants, their spouses, or any legal entity owned and controlling interest by one of those. Now, you cannot transact between or for the benefit of disqualified party, but you can transact along with. So if you wanted to be a co-owner of an investment along with your retirement account, that's totally fine. The other thing to keep in mind is when I looked and stated the disqualified parties, I did not say anything about siblings, aunts, uncles, or cousins. So believe it or not, your brother or sister is not a disqualified party, nor would be a cousin, nor would be an aunt or uncle. But even if you want to take personal money and plan money and put it into a common investment, even if you're in a 1031 exchange, for example, you can still combine those funds. 1031 has certain restrictions because 1031 prohibits the exchange of a partnership interest. So if we're looking at just combining personal plan money into a common investment, we might have the choice of tenancy in common or as common members of an LLC. If you're in part of a 1031, then it's going to require tenancy in common ownership. So once again, it takes timing, and the best thing you can do if you're contemplating one of these things is give us a call, and we'll go over what options and what sort of looks to be the best scenario for your situation. Examples of prohibited transactions. I've talked about this a few times now. It's like, okay, so the investment's rarely an issue. Prohibited transactions become problems. So assignment, so this is how easy it is to create a prohibited transaction. You find a piece of property you want to buy, and you find this before you've engaged us to put the retirement account together. So you think, well, gee, purchase sale agreements are assignable, so I'm just going to tie it up personally, and then I'll sign it over to the plan in the future. Constitutes a prohibited transaction. You took it off the market, which benefited your plan. Therefore, you've got a prohibited transaction. So if you got that situation come up, have a brother or sister write the offer and then change it over. So it has nothing to do with the assignment, the ability to assign the purchase sale agreement. What it has to do with is the fact there was a benefit to a disqualified party, which therefore created a prohibited transaction. Recourse, that's another situation that's a problem. You cannot go out and get a loan for your retirement account and have it recourse to you. So the loan's not going to be attributable to you, your credit, your net worth, anything else. It's got to stand on its own. So typically you're looking at a lower loan to value, probably more expensive money. If you're interested in taking a look at that stuff, you might go on to myiralender.com, iralending.com. North American Savings Bank is one of the big, large, banks that does source these things regularly. All right. Another situation that comes up creates prohibited transactions. If we do an IRA LLC for you, the investment the trust company makes is in the LLC. The LLC's got a bank account, and you're, once again, the manager of the LLC. The member is the trust company for benefit of your IRA. If you want to make an additional contribution to that account, it has to go from you through the trust company to the LLC. If you want to take a distribution, it has to go from the LLC back through the trust company to you. That is something that is just problematic because it takes time. Typically, there's fees involved, and people just maybe mistakenly or just ease of transaction, they want to just move money in and out directly, and that's a no-no. All right. Working on an IRA-owned asset, you can manage it, you cannot work on it. So don't get dirty. Don't pull out a hammer, fix stuff. Don't go out and paint it. You can manage it, you cannot work on it. So hire the people, the jobs that need to be done, hire people to do those things. Using that IRA-owned asset, you cannot do that. Can you buy a place at the beach to retire into? Yes, you can. Can you use that property? No, you can't. You cannot use it, nor could any other disqualified party use it until it's taken fully as a distribution. Another situation comes up, buying or selling a property or something, between disqualified parties. That's a no-no, prohibited transaction, a bad situation. Buying a property and just adding that property to your homeowner's policy, that's a prohibited transaction. That property is not yours. The property is the retirement accounts. So it's either going to be owned directly by the trust company for benefit of your IRA, or it's going to be an LLC that the trust company is a member of, but it's not you, it's not yours. If there's a benefit to a disqualified party, it's a prohibited transaction. Prohibited transactions are not good. Prohibited transactions with IRAs mean that all funds in that account are treated as distributed as of the first day in the year in which the indiscretion occurred. 401k plans is just the money involved with indiscretion. Totally different situation. Much, much more forgiving. So a couple of different examples, prohibited transaction. Can I work on a property owned by my retirement account? I hope you've gotten that. You cannot do that. Can I guarantee a loan for my retirement account? No, you cannot. Can my business occupy a building owned by my retirement account? No, it cannot. But you're saying, David, hey, we were talking about Rob's Rollover Business Startups. It's a different scenario. But for some reason, we often get calls from law firms that want to use their 401k plan to buy the building and they want to occupy it, and that's a no-no. Can I write off expenses for travel, so on and so forth, when I'm taking care of my investments to the retirement account? Once again, the answer is no. That would be a benefit to a disqualified party. So how do I create these? If it's a basic account or even checkbook IRA, first thing we're going to do is create that custodial account. If you're working with us, you're just going to let us know you want to do this. You're going to fill out a couple-page application. Really, it's just asking you about where you live, contact information, what you want to do with the money, source of funds, how much you want to use. And then if we're doing an IRA LLC, we're going to want some potential names and state of registration for the LLC. But we're going to have you return that form along with a copy of a photo ID, your current account's most recent statement. We're going to fill out a bunch of forms. One of those forms is a transfer authorization form, which allows the new trust company to go to the old one and say, hey, give me the money. You need to be in cash in that amount, otherwise that request comes across and it's not able to be funded. It's going to bounce and it's going to sit there for a while. So you just need to make sure you've got funds available. And once again, it's not all or nothing. Iras are going to tell you just move what you want to use. All right. So that's really what's involved with getting these basic accounts started. We're going to create the custodial account, and then if we're doing an IRA LLC, we're going to be doing the LLC as well. Now, an easy way to think of a checkbook IRA is this. We're going to create the necessary custodial accounts for that transaction to happen. We are going to create the IRA specific limited liability company. And really what we're doing, and I said it earlier, is that IRA LLC is going to be inserted between the trust company and the ultimate investment. A basic account means the trust company's the deeded or legal owner of whatever investment's made. And that trust company, it's going to read something along the lines of ABC Trust Company, CFBO, custodian for benefit of so-and-so, IRA number 32 or whatever that thing might be. Okay, if we're talking a property and direct ownership, that's what the deed would look like. If we're looking at a checkbook IRA, that's what the membership looks like. And I'm going to stress once again that it's a manager managed LLC. You, the taxpayer or IRA owner, are going to be the manager typically. And that flexibility, if you look at this bubble chart, so the trust company makes the investment, we're going to create the custodial account, they make the investment in the LLC, you then make all investments in the LLC's name and EIN. When they go full cycle, funds just go right back into that account. if we, and by the way, that IRA LLC could contain a single account, multiple accounts. It could contain multiple IRA accounts. It could be a his and hers accounts. You know, for spouse, we do a lot of them where we'll have his and her IRAs as members of it. You might have personal money in there too, or you might buy something and you want to ultimately take those things as in-kind distributions, and the entity may have started off just with the trust company at 100% membership, and then annually you're assigning 10% to you to take that distribution and ultimately end up owning the whole thing. So you can convey ownership or take distributions of assets in kind without changing the ownership of those things if you're just doing it through assignments and membership interest. 401k plans, really we're looking at funding that thing, so we can fund a 401k plan with anything other than Roth funds or, you know, beneficiary IRA, one that's been inherited. So we're going to be looking at, obviously the same rules apply that would with an IRA if we're funding these things. But if it's a current employer plan, depends on your age, previous employer plan, then we're good. But if you're looking at let's say a checkbook IRA or solo 401k, if you're self-employed without employees, I'm going to encourage you to do the solo 401k. It's cheaper over time. It's more forgiving. You literally you engage us. We're going to create the new plan. You're going to open a bank account in the plan's name and EIN. You as trustee of the plan or signer on the account. So it works just like a checkbook IRA. You're going to buy and sell everything straight in and out of that LLC, or straight in and out of that 401k plan. I'm sorry. If you want an LLC, we can always create an LLC that the plan is the member of too. So it doesn't mean you can't use an LLC. You're always free to do that, but it's just unnecessary to give you that trading opportunity. The other thing that the 401k plans, a prohibited transaction with the 401k plan, as I said earlier, only involves the money involved with that indiscretion. The other thing is you can borrow from a 401k plan half what's in it to a max of $50,000 too. You don't have that opportunity with an IRA. So you don't have a trust company involved, so the annual cost is lower. You're just looking at maintaining the 401k plan either with amendments or restatements, and that depends, you know, year to year what's going to be required. But they're a wonderful instrument, work great, and anybody that can fit that. And by the way, you might, let's say, be a real estate broker and your spouse helps you in the business. Well, your spouse can be an additional participant in that 401k plan without having to do anything more. So you wouldn't have to have multiple IRAs or multiple plans. You and your spouse can be participants in that one plan, which is wonderful if you want to combine funds into common investments. What about ROBS? ROBS is going to allow you to literally buy a business, create a business that's owned by your retirement account. Now, we do require our client to have at least 5% of the capital necessary to make that purchase or make this investment vehicle possible. But you know, sort of the same rules with respect to the other two types of accounts. We're going to move money as we can into the new 401k plan, and instead of like a checkbook IRA, we're combining an IRA with an LLC. A ROBS is just a combination of a 401k plan and a C corp. So we will create the plan, we'll create the corp. The plan buys the corp buys the business. Now you're working for a corporation that has ownership by both you and your retirement account. And we have used this structure from everything from Alaskan fishing operations, gold, silver, palladium mines, a lot of real estate investment companies, hotels, motels, mattress companies, car dealerships, all kinds of things. So this is something, and the franchise world understands this instrument exists, and they're privy to it, but a lot of people just are not. A lot of people in tax and legal communities are not aware that this vehicle is there. And it's a wonderful structure that allows a lot of opportunities. And you know, during the last recession, for example, we had a number of clients that had been laid off. They'd lost their jobs. The only money they had was their retirement account, and they're thinking, well, gee, I'm going to have to pull money out of my retirement account to get my future back on track, my life back on track. And pulling that money out of that retirement account can be very costly. If you're under 59.5, you're going to pay normal income tax plus a 10% penalty. So it's an ugly situation to pull the money out. Why do that if you don't have to? So, and I guess I may as well stress out with all of these accounts, we're not pulling money out of these retirement accounts. We're just changing what they can buy. So the money stays in the account. It's just we're using a different structure that allows you to go buy what you want to buy. And this rollover business startup structure has been wonderful for many businesses through many years, and it's a time-tested structure. What real estate qualifies? Rental houses, apartment buildings, office buildings, retail centers, land, any property be held for investment, a future retirement home? Yes. You cannot buy a primary residence, second home, a home for a disqualified party, or an office building to be used by a disqualified party. All those things are going to be outside it. Now, if you said, David, I want to go create a retirement account, I want to go flip properties. I made a comment earlier about dealer property, and with an IRA, you're going to have a tax consequence in that situation. Even with a Roth IRA, if you're flipping property, that's a business, not investment. So, maybe you got the same situation, even with a 401k plan. But typically, people that flip properties want to work on those properties too, which the IRA structure or basic solo 401k is not going to allow you to work on those properties. So, in that situation, we put Rollover Business Startups together to accommodate people that want to, take their retirement accounts to create a real estate flipping business. So just once again, a conversation to have, and we're going to sort of work with what you got and what you want to do with it. Combining personal plan money into real estate, we have, and I mentioned this when talking about 1031s into things, we can use tenancy in common. Tenancy in common is great because if you need additional money for the project, you're just going to come in pro rata the ownership, the tenancy in common ownership. So personal money and plan money into additional funds that need to be taken care of there. The nice thing about tenancy in common too is upon disposition, when it goes full cycle, your retirement funds can go back directly into its account while you have the ability to do a 1031 exchange if you want. Where if you're using an LLC, the second option, the LLC structure is great because it allows you to transfer ownership without changing title to stuff. It also might allow easier management of the asset. You would have a legal partnership. It's going to require a return. And then upon a full cycle event, the entity could do an exchange, or you're going to personally have tax exposure. So you would have to, if you're, the property goes full cycle and using an LLC structure, multi-member with your retirement account and you as members, if you're in a situation where you don't want to pay tax personally and you don't want to continue to go forward in the entity, you'd have to do what we call a drop and swap. And that's, once again, another topic. And if you want to know more about it, take a look at our YouTube channel, Equity Advantage 1031s. And you can, when you get there, type in drop and swap, you're going to see that, or partnership exchanges. A few examples and we're done. So I've got you 1 minute over now. We're probably got 5 minutes if I rip through this stuff, and we'll be wrapped up today. So in this situation, we had a transaction where we had a real estate broker come into us and said, hey, I've got a situation where I've got this builder developer friend that's going to, he's got problems with the property, ran out of money, he can't finish the property, he can't finish it, so therefore nobody can buy it, financing it to buy it. But he's agreed to sell it to me for this price if I, take care of him. I'll give him a chunk of the profit when it goes full cycle. So we ended up doing a self-directed retirement account for her. She went and bought the property at this much discounted price. She put the money in to do it, to finish the kitchen and the bathrooms. And at that point, she was done, and she was able to make a quick $150,000 profit. Her agreement with that builder developer that ran out of money was that she was just going to give that person a third of it back, which he was able to write, or she was able to write the builder developer a nice check for the additional $50,000 when it went full cycle. Everybody got what they wanted. So she took advantage of her knowledge, an opportunity that came up to her, and she was able to capitalize on it, and it saved that other builder developer because he was unable to sell the property because it was not financeable at that point in time. Another example is this person. This is people. A lot of times people dip their toe in the water before they go all in. And I will say this: we've put these accounts together for people that maybe get them funded, and then now they've got money sitting in the LLC. It's easy, easy for you to get upset with your financial advisor when he or she gives you a stock that maybe doesn't work. But when it all falls on your shoulders, it's a lot of weight. So you got to respect what your advisors are working on for you. But we put these accounts together, and all of a sudden the weight of the investment falls on the taxpayer, and they don't make those investments happen. But a lot of times people start off with a small investment, then move up from that. This gentleman, I love this guy. He came into us originally talking about buying a mobile home RV park, and then he also worked with a mortgage broker that he really liked, and this was way back in the last recession, so the numbers are way off. But and even in the last 5 years, the numbers would have been changed dramatically. But in this situation, his first investment was a note on a condo that was selling for $70,000 that had pre-market crash had been a couple $100,000, and he was looking at a 50% loan to value, paying him 11%. So I mean, for $35,000 plus the cost of putting the account together, he had this nice 11% return, which went great. Now, during the ensuing years, he ended up moving several $1,000,000 through us. So one of the best investments he ended up making was a wind power loan that was, I think, a little bit short of $1,000,000, but it was paying him, I think, 19%, and he was just cheering that one on to default because it was like a 10% loan to value on the thing, and it was just a great investment for him. So, he came in once again. He engaged us initially because he was interested in buying a mobile home RV park, which would have been just fine. He ended up shifting gears, started with a very small loan, and then he kept adding to his IRA LLC as investments were made possible. Therefore, he kept the money in Wall Street doing the work it needed to do until the opportunities occurred. And at that point, he'd move the money from his financial advisory account back through the trust company into the LLC, make the investment on demand. And then on the other hand, his money, as the loans were going full cycle, going back in the account, if he had a target for that money, again, he'd just make that an immediate investment. If not, he'd move it back into the Wall Street world. So this is a transaction where this is sort of once again opportunities, community-based opportunities. This is a person that had a home in a subdivision where a lot had become available. The market sort of stalled out for development, and they were concerned about if this property went away for next to nothing, what would be built there. So they really wanted to sort of preserve the value of the neighborhood and their home, and they knew that over time the property was going to go up tremendously in value. So what we did in this situation, we combined his and her IRAs into this LLC. We also had personal money into that LLC. Not all the money that was required to make the investment was available at the initial time of the funding of the LLC. So we had some of the money coming in on the terms of a note. So we had a period of time that personal contribution had to be, or obligation had to be paid off. And in that case, so normally I wouldn't want to have a multi-member LLC with disqualified parties as members funded at different times. In this situation, since that we had a finite period of time where the note was to be paid off, that was considered okay. And they made the investment, took the property off the market, preserved the market, preserved their neighborhood, and ultimately was a good investment for them. So in this situation, once again, we had a checkbook IRA with his and her IRAs in it, and then also personal money involved as well. And this is an example I always give, and this is our last example today. And so sorry if you've been on our calls before, but this is paramount to what is possible with retirement accounts and different structures. So this retired couple came to us. They initially asked about buying this mobile home RV park with their retirement accounts, and our first course of action would just be to look at it as an investment and do a checkbook IRA. Well, then they mentioned they wanted to live there and they wanted to be paid for the management. Well, both of those constitute prohibited transactions. So we shifted gears into a rollover business startup, took his and her IRAs, created the 401k plan, rolled the funds into the plan, we created the corp, the plan bought the corp bought the park, they got an investment, a place to live, and a job, all with that one transaction. That does a lot. Plan ahead takes 2 to 4 weeks to establish the account. You can purchase virtually any investment with an IRA, SEP, IRA, Roth, can purchase with family members, friends, cannot purchase from or for them. IRA 401k plan cannot sell to you or any other disqualified party. You can use an IRA 401k plan to buy property with a mortgage, negotiate from the deal's inception the IRA LLC's name, and do not overextend. We want to make sure you've got enough money in this account to make the purchase and cover any, maybe unforeseen expenses that may come up during that initial period, maybe before you have cash flow that's filled up your buckets for reserves. I want to thank you for joining us today. I would encourage you to, if you haven't, to take a look at our YouTube channels, like and subscribe to those things. You'll get a lot of information there. You can take a look at the 1031 page or the IRA page. We're happy to talk to you about any situations you may have, whether it's in the tax world, qualified money world, or combining those two things. If you've got maybe a real estate professional and you're looking to get property that you have control of out in the marketplace, you can take a look at our post 1031 website, and that may give you an opportunity to list some things there. So I want to thank you so much for joining me today, and I look forward to talking with you soon. And this is David Moore with IRA Advantage, IRAadvantage.com, signing off. Take care. All my best. Bye-bye.